I think the last time we talked about this, I think I said that the market was going to be more volatile, which it has been. I think its volatility has increased both on the upside and on the downside. I think that Powell has certainly, or clearly, signaled that he thinks the economy is slowing, not necessarily going south, but slowing, and growth rates are flat to stable to perhaps declining. And so he's not going to increase interest rates as much as he had planned, although the dot diagram still says 3 dots or 3 raises. So I think that we're just going to continue to see this volatility. And that's not going to change until there's a clear vision of where we head out of this cycle. And all this geopolitical discussion that we're having in Argentina and other places is going to lead to that volatility as well.
Long term, though, is this a negotiation or is this a real change in how we're going to be dealing with our trading partners?
Yeah, that's a good question. I think this is. I think that for this president and this administration, this is the way in which they're going to deal with the trading partners. So I think that that is a long-term prospect, at least for the next 2 years.
You think it's a successful one? We have seen deals come at the last moment when we thought it wasn't possible.
I think if success is measured on the economic impact of these negotiations, so far it hasn't been successful. The market's down 10% since tariffs, became more obvious. Now, that doesn't mean over the long run it isn't going to work. I think there's every reason to believe that there are issues with trade with China. There are issues with the use of intellectual capital. There's issues with openness in China. There's issues with convertibility of their currency. There are serious issues. Mm-hmm. They don't happen to be associated with tariffs, but those have to be resolved.
But I think part of the question, though, is that over the long term, the president will either be in office for another 2 years or another 6 years. But companies are going to have to make decisions that may have an impact over the next decade, if not longer. Yeah. Businesses like Apple that made decisions a decade, if not longer ago, to create effectively their entire supply chain in China. And I'm not saying that they're changing paths, but others are now looking and saying to themselves, okay, maybe we shouldn't be here anymore because it's going to become too expensive.
I think that's absolutely happening. I think it's at the margin today, because we're early in this phase. But if this continues to be as volatile as it has been, I think companies are looking at other alternatives. I don't think they can reasonably say to their shareholders, it's business as usual, we're just going to continue.
Okay, so investor calls you up. The show's over today. Let's just say it's 9:03. Your phone, somebody calls you and says, Peter, I'm thinking about, I got a little bit of cash on the sidelines. I'm thinking that actually now I should do something with it. Now I should not do something with it. I'm going to do something with it. I'm going to do what? What are you telling that person?
I would say the same thing I said 10 or days ago or 2 weeks ago, which was I would not put cash in the market today. I think you can participate in the market, but you should do that with options. Now that's not easy for everybody. Larger investors.
Explain that though. Explain why that's
really what I'm saying is if you put cash in the market, you're exposing your capital to any increase or decrease that the market actually incurs.
That's every day.
That's correct.
That's a reality of the stock market.
But if you have extra cash and you expose some of that by buying a premium, i.e. owning an option, and that option goes up or down, then you're not betting all of your cash and you're getting some of the benefits of the market, or you're protecting yourself in the event that you actually buy a put on the way the market goes down.
Why not just put part of your cash in stocks instead of putting all of it in?
Well, because the financial effect is actually more attractive with options.
I look at this and we've been talking this morning about how forward-looking PE is now 15 times, which it's come down pretty significantly. And that's not a terrible price or valuation, particularly if you think the economy is going to be okay over the next year.
Yeah, it's not, but I still think that you're going to incur significant volatility. And again, if I had cash, I'm already in the market. I'm sure I'm in the market, but you're increasing my position. So I think that I would not buy the market today in cash.
Okay, so
because you think the risk-reward is
I think the risk-reward is not as attractive.
Okay, let's flip it around and let's go maybe a little narrower. Mm-hmm. Rather than buy the market one way or the other, mm-hmm. Would you buy options, or would you actually put cash to work in FANG stocks, tech stocks? You look at Facebook. Is that
Well,
I
think if you're convinced that you want to have market exposure, clearly the defensives, the value stocks, those are more attractive places to be. There's less volatility to them. They're cheaper. And they're likely better places to hide in a market that goes down. You may not participate. You're not going to be up 6% like Netflix and Amazon was yesterday.
Right.
But you might be up 2 or 3%. And if the market goes down another 10%, you're not going to be down 10%.